Welcome everyone, and good afternoon. Thank you for joining Collaborative WIM's quarterly book club. And today we are very excited to discuss with you The Psychology of Money by Morgan Housel. Before we begin, just wanted to make sure we're all on the same page and just provide you a quick overview of today's event. So during the first portion of the event, you'll have an opportunity to network with everyone and meet some new friends and share your perspectives on the book or in topics in general with one another. And at the same time, come up with some questions you'd like to ask Morgan later. And as during the second portion of the event, we'll have an opportunity to ask our questions live and talk with Morgan more in depth about his book and the topic in general. Before we get started, I'd like to say special thank you to our wonderful hosts today, CFA Society Idaho. Without your help and support throughout the way, this event would not have been possible. So we are truly grateful for you hosting everyone today. And I'd like to pass it on to Jim Steele on behalf of CFA Society Idaho for some opening remarks. Jim?
Thank you, Victoria. On behalf of CFA Society Idaho, I just want to thank Collaborative WIM for their leadership, both in putting this event together and in everything that you have accomplished so far. It's an amazing partnership and we are thrilled to support it. When we were offered the opportunity to host this event, there was absolutely zero question on the part of our board that we wanted to participate. So we thank you for what you're doing and congratulate you on what you've accomplished. We had several volunteers from our society that are hosting breakout sessions today, and I want to thank all of you along with all of the other moderators. And I also want to thank Melanie Lewis for everything that she has done behind the scenes to make this event happen. She did a lot and I want to thank her. And with that said, you are all here today to network and participate in the Q&A and not to listen to me. So I want to turn the meeting right back over to Victoria.
Thank you so much, Jim, and thank you everyone at CFA Society Idaho again. And with that, I'd like to introduce our author today, Morgan Housel, who actually joined us for the entire duration of the event, and some of you might be lucky to network with him in our breakout sessions today. Morgan Housel is a partner at the Collaborative Fund, a venture capital firm that is focused on providing seed and early stage funding to technology companies. Previously, he was a columnist at the Wall Street Journal and an analyst at the Motley Fool. He's a two-time winner of the Best in Business Award from the Society of American Business Editors and Writers, and a winner of the New York Times Sydney Award. Morgan, thank you very much for joining us today, and we look forward to further discussions later in the event. And before we do a deep dive into the psychology of money with Morgan, we'll first meet in small groups to discuss our takeaways and share our impressions about the book. And while you're doing so and while you're networking with your fellow team members today, please remember to come up with one question that you would like to ask Morgan at our live session later on. And good luck, everyone. You'll now be transitioning into the breakout rooms. Welcome back, everyone. I hope you all had some productive discussions and shared your thoughts, and are looking forward to this discussion with Morgan, who is joining us live today. And Morgan, we're very, very grateful for your time today, and really appreciative of you spending your afternoon with us. And we're looking forward to this discussion.
Thanks for having me. I appreciate it.
Sure. And just to remind everyone, if you would like to ask a question, you can use the raise your hand function on Zoom, and that way you can ask your question live. Or alternatively, you can also send your question in chat, and I will make sure to read it out loud for Morgan as well. And so Morgan, to get started, I think you've shared a lot of different stories in your book, but something that would be very interesting for us if you could share a little bit about your own story and maybe tell us how you got into finance and what inspired you to write this book.
Yeah, I was actually just telling part of the story in the breakout, so I will repeat some of it. But I always knew that I wanted to get into finance since I was a teenager. I couldn't put my finger on why. I think probably like a lot of young men, it was just I wanted to be rich and powerful, which is a silly thing to think about now. But when you're 18, that makes sense to you. So I think it was just appealing to me. And the plan all throughout college was to get into investment banking. And I think that in the early and mid 2000s, investment banking had more cachet than it does today. It's still pretty good today, but back then it was like that's the center of power. It's kind of before tech became the cool thing to do. Investment banking was the cool thing to do. So then in my senior year at USC, with Sarah, this is actually where we met. We got an internship at an investment bank in Los Angeles, and I was just telling Sarah, I don't know if she knew this at the time, but from day one, from hour one, I hated it. I didn't like it at all. The culture of investment banking just was a big turnoff for me. And I was just saying, I'm fine working hard. I'm fine grinding, but it felt like it was more of a hazing culture than like productivity culture. So it's like, okay, that's not for me. Like more power to you for the people that enjoy that culture, but that wasn't for me. I got to find something else. And then I got a job in private equity, which I really enjoyed. I loved private equity. It was a great mix between investing and running a business. I loved it. It was great. So I thought, okay, this is what I'm going to do. And then that was the summer of 2007. And then the whole global economy exploded that summer and credit markets froze up and came to a halt. And if you were a private equity fund borrowing tons of money, it got really tough. So the firm that I was going to stick around with after I graduated said, there's not a spot for you or anyone else. We're struggling to survive here. So then I needed something to do in finance. I had no idea what. And as we get into 2008, it was not a good time to be looking for a job in finance as the banks were struggling for dear life at the time. And so I had a friend who was a writer for the Motley Fool. And he said, hey, you should apply to become an investment writer. And I had no interest in writing. I didn't like writing, but I needed a job in finance. It was basically out of desperation. That's the right way to put it. It's just like, I need something to do. So I took a job as an investing writer, and I thought I would do it for a couple of months before I found something else. But I really just fell in love with the process of writing in a way that I never imagined. It was totally just serendipity that I fell into this role. And I like the idea of just spending your day reading and thinking and learning and try to figure out what's going on in the world, and then trying to craft an interesting story around it that people will want to read. And writing online these days in the last 10 or 15 years is different than writing's ever been, because everyone's attention span collapsed by 90% with the internet. And it's just much harder to keep people's attention these days. This is not just true for a professional writer, but in email and any correspondence, you have 5 seconds to capture someone's attention. And if you don't, they're out of there. And so trying to learn about what was going on in the world and then trying to craft an interesting, compelling story around it was something that I really fell in love with and enjoyed. And in terms of what I found interesting, it was really this observation that you could not explain the financial crisis of 2008, which is when I began writing. You could not explain it through the lens of finance or economics. Like there was just nothing in an economics textbook that would explain why people did what they did during the bubble and during the bust. It just wasn't in there. But you could find all these clues about what happened in psychology and sociology and politics and history and biology and all these other fields that had nothing to do with investing could explain why people did what they did during the boom and bust. So that to me was just opened this door of like, okay, investing is not the study of finance. It's a study of how people behave with money. And behavior is a really broad, all-encompassing field. So if I can study that, study everything that I can think of, like multidisciplinary, and then learn something about investing and try to write about it, that would be a fun thing to do. And then after doing that for, I don't know, 13 or 14 years or so, I felt like I had enough little anecdotes to put this book together. So that's the long story where the book came from.
Very, very fascinating. And we can definitely feel your passion about the topic. And it's very interesting to observe, how you found your way and your passion in this field. We got a few questions in the chat that are kind of similar and on the same topic, that if you could share a little bit more of what your day as an investment writer looks like, maybe share some resources that you're reading that you find very helpful, and also kind of give your perspective on current financial literature and what you think might be missing from other resources that you see out there.
I would say really my job as a writer is to just try to find some insight and then try to explain it in a different way that that other people haven't already explained it in that way. So the huge majority of my day, it's very unstructured. I have almost no meetings. It's really just kind of an aimless wandering or reading and talking to people and trying to figure it out. So 90% of my week is reading, talking to people, and walking. I go for a lot of walks, which is where there's a lot of science behind people think clearer when they're walking versus just sitting stationary at a desk. So that's the majority of what I do. The actual amount of time like typing in a Word document is very, very little. It's mostly just kind of exploring, wandering around. I found that the more I try to structure and schedule my day, the least creative you become. And this is true for almost every field, that good ideas rarely come in a meeting or at your desk. Good ideas come in the shower and during your commute and when you're going for walking your dog. That's when people get good ideas. When you're just kind of like you're not forcing it, you're just letting your brain wander around. So I try to do that as much as I can, just unstructured. So it's good that I kind of always work from home because I do my best work just like sitting on the couch, aimlessly letting my mind roam around. It doesn't look like work, but that's if your job is to come up with good ideas, that's where it is. And I think there's actually an analogy there for a lot of jobs. Almost everyone on this listening right now has a thought job. Like their job is to come up with make good decisions rather than working with their muscles. And if your job is to make good decisions, you're probably going to do your best work like sitting on a couch with your eyes closed, thinking about a problem. That's when you do come up with good ideas, good thoughts. So I think that's almost a silver lining of working from home with COVID, is that more people have the ability to do the kind of work that is most appropriate for what they do, which is just coming up with a good decision. So that's the majority of what I do, is just kind of sitting around thinking and reading. And what is missing from financial literature? I'd say behavioral finance became a big thing like a decade ago. And before a decade ago, it almost didn't exist in financial literacy. And I think it's almost overplayed now. I think it's become so mainstream that it's almost taken a little bit too seriously. I think if there's one thing that's missing from financial literacy is that we still teach finance like it's math based. And in math, there's one right answer for everyone. Like 2 + 2 = 4 for everybody. It doesn't matter who you are, where you're from, there's one right answer. And I've always thought that a big part of behavioral finance is that finance is not like that. Everything is so personal. And the decision that I make that's right for me might be different from the decision that you make. Not because you have the right answer or I have the wrong answer. It's just because we're different people with different goals. We might be different ages, different families, different risk tolerances, go on down the line. So I think teaching finance, like there's a pursuit of the right answer, can be the wrong way to go about it. And I think if we taught it more as like a personal discovery of this, like become introspective about who and your family are and try to build a financial plan around that rather than trying to find the right answer. That's probably something that's missing from the literature right now.
One of my favorite takeaways from your book was the fact that there is no right answer, and it's the only right answer is the one that's right for me. But I felt like at the same time, it's very challenging for us to really figure out what matters to us, what kind of goals do we have personally with our own finances. So I think that was a great concept that you brought up. We do have a few people in the queue to ask a question live. Alka, would you like to be first?
It's a slightly longer question. So someone in our group noticed that your book speaks very well to the common person. So do you have any experience in the retail side of the business, retail management of people's finances? And along those lines, one of our other wealth managers had asked, how can you motivate people to spend less than what they can afford to spend? And then on the other side, there are those who can't overcome their fear of investing. So how do you tackle these two things? And how can we get financial education in at a very young age so that people grow up with these concepts?
Yeah. Well, first, do I have experience with retail investors? Not directly. I've been a writer for my whole career. So it's just, I don't really have experience with retail or professional. I just kind of sit here and try to figure out what's going on. But I think if it's written in a simplistic way. I was a writer, I was a columnist at the Wall Street Journal for several years. And they said, I remember someone told me when I began there, they said, your job is to write a column every week that a hedge fund manager will learn something from and a complete novice will understand. It has to do both of those things at the same time. And so I think thinking through that lens of like, how can I take something that I hope is insightful, but explaining it in a way that anyone can understand it is important. And all of the important topics in finance can be explained in simple terms. And I think a lot of times in the industry, they are not, because of just people get caught up with industry jargon, or there is sometimes this desire, this incentive to come off as being more sophisticated than you are in order to kind of prove your worth in the industry. That happens in a lot of fields, but you see it in finance too. So I think if there's a way that you can just explain things simply, particularly if you're a retail client, if you as an advisor can do that for your retail client, you immediately put them at ease of like, oh, this is not above my head or whatnot. I'll tell you where I got this from. My mother-in-law had a financial advisor at Morgan Stanley many years ago, and she asked if I would come along to a meeting just to observe, not to do anything, just like, hey, just come along and watch what happens. And we walked into the room and he started explaining to my mother-in-law about what the yield curve was doing. And I didn't say this, but I said, she has no clue what the yield curve is. She has no clue whatsoever what that means. But she sat there nodding her head because she didn't want to look like she didn't know. And I think there's a lot of that happens in the industry, even among professionals, where you want to look like you get it, like you understand it. And therefore, the big language, the complexity is just kind of has a lot of momentum in the industry. So that's the first part of it. I know there are about 4 parts of the question, and I forget what the second part is. So you have to remind me.
Oh, how can you make incentivize people to spend less than what they can afford to spend? And then the next part is get over the fear of investing.
I think for some people, the answer is you can't, and that's okay. I think there are some people who would live a miserable life if they were not spending their entire paycheck. And that's okay, even if that's not what I want to do, and I don't think it's what most people want to do. Like I've become less judgmental about how people invest and save their money. And just if that's what works for them, if that's what actually works for them, great. If there's one thing that I've kind of picked up over the years about how you might change people's mindset on this topic, it's how much spending, modern spending, for most people who we might interact with, is just an attempt to socially signal how much money you have and socially signal your worth. The cars that you drive, the clothes that you wear, the house that you live in. By and large, the reason people do that above a certain level of spending is just to show other people that they've made it, a socially signaling, like putting your peacock feathers out there. And that's fine. I think that's a natural, normal thing. For me, it was this observation. I was a valet in college at a nice hotel in Los Angeles, and people would come in their Ferraris and Lamborghinis and Rolls Royces. And I realized one day that whenever those people came in, never once did I look at the driver and say, that guy's cool. What I would do is I would think, if I was the driver, people would think I was cool. And it was like this irony of like, no one ever cares about the driver, but everyone thinks that people are looking at them. And once I got that of like, no one is thinking about you as much as you are. No one cares about your stuff as much as you do. Once you can grasp that, then I think the desire to show off to the world is way reduced. That's the only thing that I've come across to get people a little bit more aligned in it. I also think there is a natural society thing of when you go through something like 2008 or the early days of COVID, where there was a lot of economic pain going on. Those kind of movements are what is necessary to kind of reset people's expectations for what they need to save. The statistic that always got me was in March of 2020, in the early days of COVID, the average restaurant in America had enough cash on hand to survive for 12 days. That was the average restaurant. And now here we were looking at a multi-month lockdown. And so of course the average restaurant had no ability to survive. And then of course we had PPP and stuff that kind of stemmed some of that bleeding. But there's such a gap between people's room for error, their margin of safety, their cushion, and how the world actually works. There's a huge distance between those two. And when you go through something like COVID, I think it just resets people's expectations in a helpful way. And then the last part of it, like how do you overcome people's fears? I think the biggest misconception about behavioral finance is that you can teach people to overcome their biases and their fears. And I just think there's so much evidence that you can't. that all the biases that you have and I have and we all have are just part of who we are. And you're not going to change your brain chemistry by reading a book or looking at a spreadsheet. It just doesn't work like that. And so, but that's okay. It just means that we just have to embrace the flaws that we have. And if you find someone who has a lower risk tolerance than other people of their age and income, that's fine. Just let's have an investing allocation that embraces that reality. And maybe that person should not be 90% in stocks. Maybe it's 5 or 10% in stocks, even if they're young. All that matters in investing is like, can you stick with your strategy for the longest period of time? That's where compoundment works. And therefore, like a subpar investing strategy that you can stick with is always going to outperform the perfect investing strategy that you're going to abandon because you're too scared of it. And so I think for that person who's scared of it, it's just starting with the smallest amount. And maybe they're never going to overcome that fear of it. And that's okay. It's better to admit that than it is to panic and sell in March of 2020 after the market falls out of bed.
Thank you very much. This was very, very good. Thank you. And
Thanks.
by the way, I thought that the most enviable part of your entire book was your experience as a valet.
It was fun. I miss it.
Yes,
There's
I
always a
would
thing of
trade
like,
that in for anything. I thought that was the most enviable part.
I still tell my wife I would go back and do it for free, like one night a week. It was such a fun
Yes.
job. I loved it.
Thank you.
And we have a kind of a related question that came through chat from Charlotte. It's kind of related to the consumerism notion and kind of wealth disparity that we have seen that exponentially increased, especially post-COVID. I think we all can agree. And Charlotte is asking if whether you see this exponential increase of ultra wealthy and billionaires in the world leading to or making any positive impact. Or are you encouraged or discouraged by values of this consumerism oriented ultra wealthy?
It's a great question. And I'm less concerned with like, is it good or bad? Because it's a very divisive topic because by nature it's political. So whenever you talk about wealth inequality, it's like it's hard to discuss for me or anyone else. So rather than good or bad, I just look at the fact that it's happened and it's changed a lot of people's views. Whether you think it's right or wrong, it's happened and it's changed a lot of people's views. And you're right that wealth inequality had been growing consistently since the early 80s and growing a lot. And then COVID just like smashed it apart. It just like the trend was rising and then COVID just like went supernova in 2020 because you had tech companies who could work from home and their business was better than ever. But then if you were a dry cleaner and you had to shut down for a year, and now that you're open, your business is still down 50% from where it was before, you're in something that is literally worse than the Great Depression. And so that divergence has just like exploded in the last 2 years. To me, the biggest way this impacts people is that everyone's expectations for the life that they expect to live is based off of their peers around them. Like you just look at your neighbors and your coworkers and you're like, oh, that's the life that they live. That's the car they drive, the house that they live in. That's my expectation of what I expect out of my own life. It's just like a comparison thing. And particularly in the age of social media, when your neighbor, so to speak, is everyone on Instagram, and everyone is opening up and looking at like pictures of private jets going to Hawaii and Lamborghinis and stuff, that sets people's expectations of what they think their life should be. And it inflates their expectations. So when you have a small group of people who earn a tremendous amount of money and their lifestyle is inflating everyone else's expectations of what is normal, that I think does lead to a lot of problems in society. And I think if you look at a deep history all over the world, you really want to avoid a big segment of your economy waking up every morning and saying this is not working out for me. This isn't working for me. That's when you get big problems in society. And I think the more that people's expectations are inflated above their results, when their expectations are rising faster than their income, you're going to have more disenchantment with what's going on. Even if we are today, the median worker in the economy in 2022 has a higher income, a higher standard of living, a bigger house, better healthcare, better retirement than they did 50 years ago. If their expectations have grown faster than their income, it can all fall apart pretty quickly. I don't have any prescriptions for what the solution to that is. I don't envy the politicians who have to figure out what the prescription for that is. But I think wealth inequality was the biggest economic story of the last 40 years before COVID, and COVID just increased it by an order of magnitude. So it'll definitely be one of the biggest stories of the rest of our lives in terms of economics.
Definitely. We have Kelly in the queue to ask a question. Kelly, would you like to unmute yourself and ask your question?
Sure, thank you. So a question that came up for us is at the end of the book, you give some sort of suggestions or recommendations. And one of those is to avoid the financial extreme decisions. But then you also talk about how you're 100% passive invested. So that brought about the question, how do you even go about defining what the extremes are in order to avoid them?
Yeah, that's fair. I've never had that rebuttal, but I think it's totally fair. By the extremes, what I meant from that is the extremes of like the people who save 90% of their money, like the FIRE movement on one end, and the YOLO, spend everything, go into debt, live your best life on the other end. Those two extremes, if you accept that people change over time, I think will lead to the highest odds of regret. When, let's say, you've saved 90% of your paycheck and you build up a huge net worth and you retire when you're 27, and then you quit your career, you quit your job to retire early, and then you miss your coworkers. You feel like you don't have a lot of purpose or identity in life. Like the more extreme your plan is, the more that I think it increases the odds of regret. That was the point that I was trying to make there. Passive investing, I mean, is what I do. So of course I'm talking my own book here, but to me it doesn't seem that extreme. It seems like it almost seems like the opposite. Like it's as diversified as you can possibly get. That's how I view passive. You own the Vanguard Total Stock Market Index Fund, which is 3,000 companies that I own. So to me, that's almost the opposite of extreme. It is all in on one strategy. I'll give you that. But the strategy that I have for investing is I just want to bet on the global economy. I want to own a slice of global capitalism. And I think if you own an index fund, that's what you do. And so, yeah, I think that's fair. And most of what I recommend in the book and all these flaws are things that I've noticed in myself. So I don't, at the end of the book, if people say, well, Morgan, you do this and that. So, yeah, I'm as flawed as anyone else too. And we all are. Daniel Kahneman, who won the Nobel Prize for his work in behavioral finance, was once asked, has 50 years of studying the human mind made you better at making decisions? And without hesitation, he said, no, not in the slightest, that he's still as flawed as anyone else. So if Kahneman, who won the Nobel Prize for half a century's of work in this, if he is still as biased as anyone else, like the rest of us normal people don't have much hope for us either. So I think rather than trying to fix your flaws again, I think the best you can do is just acknowledge them and build a plan around them.
Fair enough. Thank you.
Thanks.
See that Danielle has a question as well. Danielle, would you like to go ahead?
Hi, my question came up in our group, and it has to do, it goes back a little bit more to what you were talking about with the 08, 09, and well, even now, how do you view government intervention in the markets, whether it's setting interest rates, bailing out an AIG, canceling student debt? How do you feel that's affecting investors' decisions and perceptions of risk?
I think to some extent, when people look at government interventions and say that is really impacting how people think about risk and whatnot, I say that might be true, but in a lot of ways, that's always been true. I mean, the Federal Reserve has been around since 1913 and has been manipulating interest rates, that's how some people put it, for over a century. And if you look at how the economy was run in the 1930s with the New Deal, in the 40s with World War II, in the 50s with kind of the GI Bill and 91% marginal tax rates, there's always been a tremendous heavy hand of government intervention in the economy. And so I honestly don't have many views on whether that's good or bad because it's such a complex topic. Anyone who falls like firmly on one side, I think is probably being a little bit disingenuous. I just view it as that's how it's always been. And that's probably how it always will be. Like if you and I are having this conversation 30 years from now, the Federal Reserve is going to be setting interest rates. There's going to be a massive government deficit. There's going to be huge government. I think it's always going to be like that. So rather than is it right or wrong, I just view it as that's how it is. I do think there are obviously periods like in late 2008 where the decisions that they made, both at the Fed and the Treasury, were so controversial. I understand why they're controversial, but the alternative to that, I think easily would have been just financial catastrophe. And there's so much history around the world that financial catastrophe leads to societal collapse. it's all hyperbolic, it sounds, but I think it's really true. Whether it was Germany in the 1920s, or a lot of what's happened in Zimbabwe and Brazil and Venezuela in the last couple of years, financial collapse leading to societal collapse is a really real thing. There's a story from a congressman, I forget who it was, but he gave an interview in 2008, and it was him, Ben Bernanke, and Nancy Pelosi, and they're having a meeting, and they're talking about, hey, we need to bail out the banking system. And I think it was Pelosi who said, great, like, let's have a conversation about that on Monday. And they're talking on Friday. And Ben Bernanke said, if we don't fix this by Saturday, you need to declare martial law on Sunday, because there are not going to be any banks on Monday. And I don't think that was hyperbole at all. I think that's effectively what happened during the Great Depression. I don't want to go too far down a rabbit hole here, but well, there's a story from the 1930s where there was a group of congressmen and businessmen who came together and were forming a plan. It's now called the business plot, to overthrow FDR and take over the government and form a fascist government that was sweeping through Europe at the time. It didn't happen, but you get these really extreme outcomes when you have financial collapse like we had in the 1930s. Now, I'll cap this off here because I don't want to keep dragging on this forever. But the problem is, what is an emergency that requires that, and what is, okay, we're past the emergency, so now you need to back off. That's where the problem always is. And taking the punch bowl away, so to speak, is so much harder than it should be. And because it's hard to, once you give someone a medicine, taking it back is always so much harder. So that's in general where I fall down on that.
Do you think that investors, especially maybe, I don't know if I'd say younger ones, but because they sort of know there's a backstop, that they're making riskier decisions? Because just with that in the mindset, I don't know if you've seen that, if people will take more risk because, well, they'll forgive it later. They'll, in that way where they see that the sort of precedents that have been set, and then they use that to make their decisions. I don't know if you've seen that happening, or.
I think that's probably right, that the moral hazard that exists in bailouts is real. If there is any pushback about it, it's by and large the big banks, not individual investors, but the big banks, after they got bailed out in 2008, did manage themselves better thus far. Now we're 12 years past that, something like that. Thus far, they are better capitalized. A lot of that is just because the regulations have changed. But moral hazard is real, absolutely. I think that's definitely the case. But again, I think that was true 100 years ago, and it was true 50 years ago. So I don't know if what we're dealing today is necessarily that different. And I don't know if it will be that much different in the future. If anything, I think it'll be more, because once you set the precedent of what the government is able to do in terms of bailouts and stimulus checks and enhanced unemployment benefits, once you set that bar, you have to meet that bar the next time. And I guarantee the next time there's a recession, there's going to be enhanced unemployment benefits, $2,000 checks sent out like we did in 2020, because that's what people's expectations will be. So if anything, rather than, has this made people, dangerously, taking too much risk, I think if anything, it's probably the right mindset that there will be future backstops. Now, that's not an excuse to go out and just lever up and gamble away, because a lot of people in 2008 and 2020 and today in the last couple of months are wiping themselves out and losing a ton of money. And even when you talk about AIG getting bailed out, well, AIG shareholders lost 98% of their value, which was not 100%, but they were like, AIG shareholders did not walk away thinking they got a sweet deal.
And it was more about Greenberg and, the evil ones at the top.
Yeah. And most of those guys, like Hank Greenberg of AIG, he lost 90% of his money. Again, 90% is not 100%, but those guys did pay a price, not the full price, but they lost quite a bit, as did homeowners in 2008, and a lot of tech stock investors in the last 60 days are also, experiencing this side of it. So I think what you're saying is absolutely true, but it's been true, and it doesn't mean that you still can't lose a lot of money.
Thank you.
Yep.
Danielle, and we had a few questions that came in through the chat, which are kind of similar. To elaborate more on Danielle's question, is whether, Morgan, in your research, you have seen any differences of how people behave with money depending on their age or the generation they're from, millennials, Gen Zers, are they different from Gen Xers? And maybe second part of that question as well, whether men and women behave differently with money and in what way?
I think generationally, the answer is probably not, because what is Gen Z doing today? Well, they're big into Robinhood, they're big into meme stocks and tech stocks, they're big into crypto. But my generation, when we were in our late teens, early 20s, it was the same. We had our Scottrade and our E-Trade accounts, and we were day trading tech stocks in the 90s. So even though like the scene changed, I think the mentality is very similar. And baby boomers had their fun in the 60s. And of course, there was the booms of the 20s. Like every generation has that. So even though the scene changes, it's like it's the same movie every time. And I think every generation will go through that speculative phase, and then there's usually a washout, and then they learn, and then they kind of move on to what's next. So I actually think it's very similar in terms of how the generations have played out. Yeah, what was the second part of the question? I'm sorry.
Whether women and men behave differently with money.
Here's what I think is the case there. And I have to, my disclaimer here is like, I'm very much generalizing here. This is not an indictment on anyone. But I think if you think about getting rich versus staying rich, the two very different skills, I think in general, men tend to be better at getting rich and women tend to be better at staying rich. I'll explain that a little bit, which is men, I think, are more inclined to want to take a huge risk, to swing for the fences and just go all in. They're more inclined to do that. Women, I think, have a better sense of managing risk, and therefore they're less willing to swing, to put it all on black, say, but they're much better at staying rich and managing risk. Now, of those two sides to do well over time, getting rich versus staying rich, the staying rich is by far the more important part of it. It's preventing yourself from being wiped out is the key to long-term financial success. So those are my general views on it. But for every one of those, there's a million counter examples. It's not an indictment on anyone individually, but I think in general, that's what it tends to be. And more than men versus women, I would say it is younger versus older. That younger people, like most teenagers, when they start out investing, if they start investing, their natural inclination is to day trade penny stocks. And it's not because they have a gambling mindset. It's just like, that's what intuitively makes sense. That's how you're like, oh, how can I get rich fast? Let's try this. And then you usually lose money doing that. And then you're like, oh, maybe I'll move on to this. I'll try to hold stocks for 3 days rather than day trading them. You lose money doing that. So there's always like, it's definitely that progression of age where you're learning about risk. And then you go through a big crisis like 2008 or 2020 that resets your view of risk in the world. And you're just constantly learning about risk as life goes on. So I think like the life cycle of generations is probably more important than the male versus female side of it.
Interesting. And we certainly hope that maybe in your next book, you can bring up some of those stories discussing women or any other diverse groups and how they behave with money. We had a comment from one of the audiences in the chat box that they would definitely like to see that.
There's a good book by a friend of mine named Luanda Cosmo. She wrote a book called Warren Buffett Invests Like a Girl. And she talks about the research of basically what I discussed of women are better at managing risk in general. And so much of investing just comes down to, can you keep your head on straight when the market is losing its cool? Like when there's a big decline, when there's a panic, can you personally stay calm? And like that, controlling your emotions side, I think is probably more women are probably more apt at managing those emotions in periods of panic than men tend to be.
Interesting. We have Lamika, who also wanted to ask a question.
Hi, yes, thanks. I was wondering how charitable giving fits into your ideas about the psychology of money. A lot of the sort of summary points were save it, drop your ego, don't spend more than you have. So where should we start considering charitable giving? Is it in the beginning, or is it once we've amassed a certain amount of wealth? What are your thoughts on that?
I'll be honest with you. I know this is not the answer out personally.
Mm.
My wife and I haven't really figured out how to do it in a way that we feel like we're making a big difference and it fits our values and whatnot. It's certainly something it's near the top of the list of like, what do we want to get better at financially? That's close to it. But I feel like I can't give you advice because I haven't figured it out myself personally. I get that question a lot from the book of like, hey, you didn't say anything at all about charitable giving. And the reason why is because I haven't figured out. If there are other people here who have more insights than my 0 insights on that, I'd be curious if there's more, but it's definitely something that I want to dig into more and figure it out.
Thank you.
Lee, would you like to ask your question?
Hi, Morgan. Thanks for joining us many times. So I'm curious about your experience or your journey of becoming a writer. So going back to the beginning, sort of. So I've been really curious about the species of venture capitalist and writer combination, like Michael Moritz and Sequoia Capital of the world. So curious about what's your journey like in becoming a writer? Who and what event in particular would you call a pivotal moment to propel your growth as a writer? And looking back and looking forward, how do you think becoming a writer has made you a better or maybe worse venture capitalist?
First, the nuance is even though I work at a venture capital fund, my job is writing and speaking. That's what I do. So it's been a great home for me, but I'm not active in the day-to-day deal flow, making deals. I'm part of the team. I'm a partner at the firm, but content is what I do. So it's not like Michael Moritz, who was a journalist and then became truly one of the greatest VCs doing deals himself. I'm slightly different in my day-to-day role, but since my early years of writing was out of necessity, it wasn't like, oh, I love writing or I'm good at writing. It was just like, I need a job and this is the job that I have. And in 2008, if you had a job, you held onto it with both hands and you didn't let go of it. So early on, I didn't enjoy it. I wasn't particularly good at it. It was just what I was doing. But as I think the years went on, it took several years of really enjoying the process of just being an outsider, like not a fund manager, not a financial advisor, just how can I be up in the bleachers watching everyone else and trying to figure out what's going on. And I've always just been interested in what's going on inside of people's heads, not what they say or what they're supposed to do, but just like, what are people thinking? How are they justifying their decisions? I've always liked that side of it. And so I just wanted to spend my time doing that. I've also, like, personality wise, I don't consider myself an introvert at all, but I'm totally comfortable just being in a room by myself, reading and thinking and writing. I don't have any need to be in a busy office with other people. And so it's fit my personality quite well. And so it's just been, and I think it's changed a lot too. Early on, it was writing about the financial crisis. And then it was kind of writing about the recovery. And then it's moved from more of like a writing about the news, like writing about what happened that day, what happened that week, towards just writing stuff that I want to be more evergreen. Like what was true 100 years ago that will be true 100 years from now is really what I've been interested in. Writing online is tough, particularly early on, because online people it's almost like road rage where people just kind of lose all sense of humanity and they will let you know what they think of your article or your tweet in no uncertain terms, for better or worse. So a lot of new writers really find that out the hard way when they write something, even if it's a great article that you think should be uncontroversial. People will say some terrible things about it, no matter what you're doing. So I think growing that thick skin is tough. And I see a lot of young writers, and it's sad to watch, of like, they have a lot of talent and they're doing it, but they can't, I don't blame them. They can't handle the swamp of comments that comes from it. So that's part of writing online in any field these days, I imagine. If you're doing anything online and putting your opinions out there for the world to read and respond to, a lot of the responses are not going to be very, very civil. So I think that's actually a big part for new writers that goes overlooked.
Great, thank you for sharing.
Yep.
Morgan, you're definitely one of our most favorite speakers. Such an incredible engagement from the audience, and we have so many questions that came in through the chat, and we still have some people waiting to ask their questions. So I just wanted to mention to everyone that we're running up against time, but I just wanted to make sure that we get people get the chance to ask their questions, those who have their hands raised. So we'll we'll get to the last couple of questions here. And Mike, would you like to go next?
Yeah, thank you, Victoria. Danielle made a comment, a question. I was listening to your question, Danielle, and I definitely do think some of the government responses have changed investor behaviors, that safety net that's put in there. It seems like you look back over the past 15 or 20, 30 years, the government playbook to economic crisis is getting thicker and thicker and thicker. And I'm now of the mindset of I expect to be saved. So I almost look at those big market crashes as providing great opportunities, because you know, if the market's down 30% or so, go all in, because it's someday the government's going to write the check to put everything back in order. And then I also have a saying, it's kind of interesting, some like it, some don't, but it's only kinky the first time. And so when they do it once, you know, it's fun, but then it just goes to add to that playbook. So now I fully expect in future economic crises to have rent moratorium and mortgage moratorium added to the government response. I thought that was a great question that you asked, is how does the government response, not whether it's good or bad, but how does it change the psyche of investors? And it has affected me. I started my career in '99, so I was started off by 3 years going down. But
here's one thing that that comes to mind when you say that. For most government responses in modern times to recessions has been trying to fill a demand hole with cutting interest rates and stimulus packages. And that's for, if you're a consumer, if you're an investor, that's a great government policy response. That's going to fuel you, like whatever you're doing. It's very different if the government is trying to fight inflation. That's totally different. Then the government response that happened in the 70s and 80s was jacking up interest rates as high as they could. And that was the medicine that they were giving. That was the government's response to trying to fix the economy. It just went against you. So I think we have in the last 20 or 30 years or 40 years, government response has all been stimulative. And if we are going to head into an inflationary period where the responses are negative, it's negative medicine. And rather than stimulants, it's, you know, it's like it's like tranquilizers rather than stimulants. That's a totally different view. So I don't really have any views on how long this inflationary deal that we're dealing with right now will stick around. But that's, you know, if you look at the New Deal was huge and very stimulative, and then World War II was huge and stimulative, but the 70s and 80s with Volcker were a brutal time for government policy, and that was all just designed to fix the problems of the economy.
Yeah, but there was also more of a laissez-faire attitude back then. And, you know, hey, this is capitalism, and now we want to take the edges off of capitalism, so to speak. Yeah, I hear what you're saying. Morgan, thanks for the conversation. You know, I have a question on, we had a great conversation actually that was led in our group by Alka too. She did a good job. But, you know, when you look at decision making, you know, there's a lot of very smart people, probably a lot more people smarter than me on this call. Technical skills, mathematics, critical thinking skills, problem solving, you know, but sometimes when you're sitting with the client, you know, you've got all that calculus going on in your head, and they're speaking what the driver that's going to solve their problem is an emotional driver. It's not a mathematic. How do you deal with things? How do you move people from the emotional to the logical? Or do you, and so many decisions, I can pencil them out and they're going to say, no, I don't want that solution. I want this solution because it's more emotionally appealing. How do you handle that dichotomy? And when do you move people? How do you move people from the emotional to the logical?
I think the biggest is that in any field, this is true in politics, it's true in medicine, it's true in finance, that data really doesn't change anyone's minds. Good stories change people's minds. And sometimes you can make a good story with data, but data on its own is almost never persuasive on its own. And I think that is a problem with some of the smartest people in finance who are so data oriented, and they're brilliant, they're geniuses, but they're not very persuasive communicators. In particular, if you're a financial advisor or even a fund manager who's just trying to, you know, writing your LPs letters and trying to get your investors on board with what you're doing. Telling an effective story with the data is how you change people's minds. There's also a thing in a lot of fields called the curse of knowledge, which means that people who are experts underestimate that novices don't have the expertise or understand the lingo that they do. So this is like the financial advisor telling my mother-in-law about the yield curve. He wasn't doing that to mislead her. He just, in his mind, everyone knows what the yield curve is. And so I think it's, in any field, particularly if you're a financial advisor, learning how to communicate effectively and tell a good story doesn't seem like that should be the skill of a financial advisor. You want to talk about asset allocation and valuations and whatnot. Storytelling, though, in any field is really the key that I think sets apart a lot of the experts, including, I would say, someone like Warren Buffett. Yes, he's a very skilled technical investor. Yes, of course, he's very knowledgeable, he's very smart. But I think his most overlooked skill is that he's such a good communicator that his investors for 80 years have completely understood what he's doing and are willing to stick with him through thick and thin. And never are they, when he was a hedge fund manager, were they going to say, oh, we're going to withdraw all money this quarter. Because they understood exactly what he was doing and why he was doing it, because in his writings and his TV interviews, he's so crystal clear and can communicate so well. So that I would say for all, either if you're a portfolio manager or a financial advisor, like your ability to communicate and tell a story is of equal importance of your technical ability.
Thank you.
I think that my breakout room was impressed with in your book, Morgan, is that how you can put together all these concepts in such a simple way and easy to understand, but not oversimplified per se. So we were very impressed how easy and digestible the book was for everyone.
Thanks. That's great to hear.
It looks like we have one last question from Jamie.
Thank you, Victoria. Thank you so much for being with us today. First of all, I have to say, fight on, because that's just how it goes. And we also purchased copies of your book for actually majority of our clients in the last month or two here. So similar to Mike's question to some extent, I wanted to see if you have any kind of recommendations or advice for how to help them assess some of those money stories that they grew up with and kind of embrace that reality, as you mentioned, too.
I think a big part of that is understanding that your past behavior is the best indication of your future behavior. And so if we talk about investing, if you panicked in 2008 and sold everything, if you panicked in March of 2020 and sold everything, all the evidence we have shows that you are probably going to do that again during the next market crash, that you are not going to learn from your mistakes. And again, like you can't rewire the hormones in your brain by reading a book. It just doesn't work like that. And so most people tend to be in the future who they were in their past during these moments of panic. And it's, again, I think that's okay. You just have to embrace that that's who you are. And understanding that if you panicked in the past, hey, that's fine. Let's just have a little bit less aggressive asset allocation, even during the bull market. So we need to be prepared for the time you're going to panic again next. So just using that mirror of your past and being introspective about who you are is, I think, the best that we can do to understanding our own flaws. So I do this with myself and my wife and our own money, just trying to be like, what have we done in the past? What have we liked in the past? And that's who we are. And that's the flaws that come from that. We just have to embrace and accept that that's who we are. So I read some of that, near the end of the book about how we manage our money. And a lot of it is not rational. It doesn't make a lot of sense. I can't explain it on a spreadsheet, but it's just like, this is who we are. This is our personality. This is what helps us sleep better at night. And if you just come to first principles and be like, the purpose of money is to give yourself a better life. It's not to make the spreadsheets happy. It's not to like make sure all the formulas add up perfectly. It's just, how can I use this money to make my life better for myself and my family? And what I do might be different from what you do. And that's fine. It's just, we're different people with different personalities. And if we just embrace that, I think that's the best we can do.
Awesome. Thank you so much.
Thanks.
And before we close off, Morgan, a few people in the chat were wondering about what's next for you in terms of your career, or maybe your next book or next project. Could you share a little bit about it with us?
Well, two things. They're turning Psychology of Money into a documentary, which is a long and slow process. I think a lot of Hollywood is still shut down because of COVID. I don't know when that will take place. It might be a year or two. I don't know, but that'll be a thing. And then I'm working on this on another book, which is the behaviors in business and finance that never change. Like what was true 100 years ago, that'll be true 100 years from now. There's so much focus in finance on what's changes, like what industries are changing and how's the economy changing. But I just want to look at what is just an integral part of how humans think that will always be with us. So that's the second book.
Yeah, very interesting. And I think we certainly will have to have you back. This has been such an engaging discussion, and we still have so many questions that came in. And I think we will have to have a part 2 with you for sure if you are up for it, because there's definitely very, very good discussion. So we're very thankful for you, Morgan, for joining us today. And I think each one of us learned something new while reading your book, but also while just being here and chatting with you, and such an incredible opportunity for all of us to just see you live and being able to ask our questions. So thank you so much for your time again.
Thanks for having me. This has been fun. Thank you.
I would like to thank our hosts again today, CFA Society Idaho, and all volunteers for facilitating our discussions and for making this event possible. We have enjoyed to catching up with all of you today, and definitely look forward to see you again at our future events. You'll see momentarily, you'll see a few events that we have coming up in the next few months that we would be happy to see you. We have our quarterly webinar on February 15th, where we'll discuss power and payoff of non-consensus investing. That would be a great event for everyone as well. And our next book club is coming up on April 13th, and we will discuss Master Mentors with Scott Miller. So those 2 events would be great to attend, and we would love to see you all joining us as well. And with that, that concludes our event today. And thanks again for everyone for participating. And if you have any questions or feedback, please reach out to us. It was great seeing you all, and I hope everyone enjoys their afternoons. Thank you.